Hi, I'm going to review some of the key ideas I think from Chapter 3. Chapter 3 is a chapter that covers taxes with particular emphasis on income taxes. Um, the key learning objectives in this chapter are to learn about some of the major taxes paid by people, to learn how to calculate taxable income, and then after you've calculated taxable income, to get an idea how you would calculate the amount owed for federal income tax. And 3, get a sense of what's needed to prepare a federal income tax. And finally, a very important idea is to use what you've learned about income tax and income tax preparation to develop tax strategies as a way to minimize or reduce the amount of taxes that you pay. As I've said in earlier talks, the point of these little short lectures I give here are not to give a full and complete lecture of the material covered in the book. The online lecture on the Connect website does a really good job of reviewing the major ideas from the textbook. They give a lot of details. Instead, what I'm going to do is highlight what I think are, in this particular chapter, really 2 just key, very important ideas to take away in the long run. Let me also make one criticism, I think, of the book. One criticism I have of this chapter is that the chapter is really about taxes of all forms. And in fact, the chapter probably spends 80 or 90% of the time talking about income taxes. And that, I think, is really a shortcoming. Individuals pay many types of taxes, okay? And here's a list of 4 major taxes that people pay. And income taxes are just one part of them. So you pay on a regular basis, you pay taxes on things that you purchase. New Jersey has a sales tax. There are also excise taxes imposed on a number of items you purchase. There are property taxes. You yourself may not yet have purchased property, but if you do, New Jersey has substantial real estate property taxes, and also there are some personal property taxes you might have to pay. There are also taxes on wealth, including the federal estate tax. There's also state inheritance taxes. And finally, there are taxes on earnings. And on taxes on earnings, let me note that they are income tax and Social Security taxes. I want to emphasize that one thing that's often, I think, mischaracterized is that while a substantial fraction of the population earns low enough income, they don't have to pay income tax. That is not, it's not correct to say those individuals do not pay taxes. And this kind of misconception in the past few years got certainly a lot of attention when Mitt Romney quoted something like this in his campaign in a derogatory way. It is incorrect. Even if you make low income, you are paying taxes. And in fact, it's often the case that people at the lowest income levels pay higher, have a higher tax burden than people in medium or slightly higher income levels. And that's because many of the taxes that you pay are regressive. That is, you pay a higher fraction at lower income levels. That'd be, for instance, Social Security and sales taxes are often viewed as regressive taxes. Okay, so there are 4 major types, I would call classifications of taxes. And other than mentioning this and giving you a brief discussion of it, the chapter does not really discuss these other topics. In the economics department, we do have a class called Economics of Taxation that covers all these ideas. And it's something that if you're interested, you might be interested in taking in another semester. Let me say one thing about this chapter, and one thing that's been a huge improvement in the last 20 years, which is really the advent and accessibility of electronic income tax preparation. Whether or not you use these programs to submit your taxes electronically or you use them to print up forms and you submit your forms, the ability to use this computer software to do your taxes is a huge improvement. As someone who spent many years, and in those years multiple nights going through the tax forms, doing calculations manually, the ability to use tax programs is an absolute godsend. I've listed 3 major tax preparation websites: TurboTax, H&R Block, Tax Act. There are reviews of these websites online. I'm not going to review. My own preference is TurboTax, but that's as much for historical reasons that I've used it for a long time. They're all good programs. I've read a lot of reviews, and the truth is they're all fine. What's important is almost surely for almost all students in my class, the online versions, which are free, are sufficient to handle your income tax situation. And that is, you actually don't need to pay for income tax preparation. As you earn more income or you start to accrue more investment and other types of income, you might need the paid version. But more than half the people in the country's income and expense are sufficiently simple that the free programs can do everything that you need. And so I would recommend you to look at these websites. Again, you can go online and look at the reviews. Any of them will be sufficient for your tax needs, and they are so far superior to doing them manually, getting the forms out and doing them by hand. So one thing you might ask is, if it's all done electronically now, Professor Perugia, why would I need a whole chapter on this? I mean, I just go into the program, I enter my income, it does all the calculations, and it tells me at the end what I either owe in taxes or my refund is. What else do I need to know? Why do I need to read this chapter? It turns out that is very naive and simplistic. There's a lot more you need to know about taxes than simply how to go to the TurboTax website or the H&R Block website and start the free web program to calculate your taxes. So the reason why you need to know more is your goal should be to retain as much income as you possibly can. And that is, you want to pay the minimum legally required amount of taxes. All right, this is not the idea that you're trying to avoid taxes, but if you don't know about taxes, it's hard to take actions to reduce the amount of taxes that you can pay. So having a sense of current tax laws, maintaining complete and appropriate tax records, and making purchase and investment decisions can help you reduce your tax liability. So one of the goals of this chapter, which fits in kind of with the theme I have for this course, is I want you to have as much income that you can use for your own purposes. And that might be involving in good budgeting programs, learning how to budget yourself. We're going to talk about investment. We're going to talk here about taxes. So with taxes, you're going to need to pay your fair share of taxes, but I want you to take advantage of all the tax benefits that are available to you. So in the big picture, this chapter focuses really on income taxes. And so I'm going to highlight some ideas here that are important when you do your taxes. So when you do your income tax form, there's basically a set of questions, part of the form, that relate to income issues. And then there's going to be a set of questions that you'll have to answer that relate to allowable expenses, deductions, and credits that you can use to lower your taxes. So here on this page, I have listed 4 main types of income. You have earned income, and for many of you, this will be really your main income. This would be like your wages. if you have a job, your salary, commissions, tips. That would be earned income. Investment income would be income that you will earn from dividends, interest if you have savings accounts or CDs, or perhaps if you ultimately become a property owner and you rent apartments or a house, the rent you earn from investments fall into this category. There's passive income. This would be income you earn from business activities in which you do not directly participate. That would be, for instance, like if you had a limited partnership in a firm or some operation. That's probably not relevant for most people. And then finally, there's other income category, which is kind of a catch-all box for income. It would include things like if you're receiving alimony payments, if you've received an award and received some income with that award, if you happen to win the lottery. By the way, please stop by my office so I can share in your good fortune. But your lottery win-ins need to be declared, and that would what I'd call under the other income category. One thing that the book does discuss, and it's important in terms as you go on, perhaps not when you're 20, but as you start to earn, you graduate from college and earn larger income. Some income that you receive is not taxable, okay, or the income you earn is tax deferred, and that is you don't pay taxes on it today, but rather you may not have to pay taxes on it until so you're 65 or 70 or something like that. So the book discusses that, and it's something you should learn, because one of the ideas is by either earning income that's not taxable or deferring your taxes is a way to increase your savings and investments. There is two, what I would say, big lessons in this chapter I take away that I really want you to understand. These two ideas are ideas that I guarantee are not understood by 90% of the population. Lesson number one, a tax deduction is not the same as a tax credit. A tax deduction is the amount subtracted from adjusted gross income. So for right now, you can just consider adjusted gross income as your income. There are some adjustments the IRS allows you to make to it, but for right now, you can think of your income. And then there's some deductions. There's often standardized deductions, or in many cases, it'll be in your advantage to itemize your deductions, okay? And then a tax credit is different in that the amount of the tax credit is subtracted directly from the amount of the taxes owed. So, okay, there's the two definitions. Yes, I can see the words are different. Which one is better? Or is one better in all circumstances? Or sometimes would you prefer a tax deduction versus a tax credit? If Congress is debating whether to do something, would you rather have them do it in the form of a tax credit or a tax deduction? Okay, so looking at these definitions, you may say, what? That's really confusing words, Professor Prusa. I have no idea whether I want a deduction or a credit. Let me give you two examples. One example of how a deduction works, and then I'll give you an example of how a tax credit works, and I think it'll be clearer the differences and then why one is clearly preferred to the other. A deduction, the idea of a tax deduction is you subtract it before your taxes. So I've made up some hypothetical numbers here. Suppose your income were $50,000, and suppose the standard deduction is $5,000. Let me emphasize that that is not the current standard deduction. It changes every year. It differs between whether you're a single person filing taxes or a married person. So this would not be the amount you'd enter on your tax form. Again, if you're using the tax software, it will enter the correct standard deduction for you. This was just $5,000 was a nice number I wanted for this example. So you have $50,000 of income. It's your first year out of college. You have a standard deduction on your income tax of $5,000. The way deduction works is you subtract your deduction from your income. So you come up with your taxable income of $45,000. So $50,000 minus $5,000 is $45,000. And then suppose for the moment, suppose your tax rate's 20%. Okay, and in that case, your taxes are $9,000. And how did I get that? Well, your taxable income is $45,000. You multiply it by your tax rate, that's 0.2. Okay, I'm assuming kind of a flat tax. Everybody pay 20% on all your dollars. Then you'd owe $9,000 of taxes. So with a deduction of $5,000, you'd have $9,000 of taxes you'd owe. Okay, now let's look at a second example. And this is an example. It's the same person making $50,000, but instead of having a $5,000 deduction, in this example, I'm supposing you have a $5,000 tax credit. Okay, so how the taxes work is here, your taxable income is $50,000. There's no deduction to subtract, so your taxable income is your income. Okay, and then again, assuming your tax rate is 20% for all $50,000, your taxes before we take into account the credit is $10,000, right? So you take your $50,000 of income, multiply it by 20%, and you get $10,000. Now is when the credit comes into effect. You subtract the credit after you've computed the initial taxes. So you've calculated that you'd owe $10,000, then you subtract the tax credit of $5,000, and you get that you have $5,000 owed. So in this example, with a $5,000 tax credit, your taxes are just $5,000. When you had a deduction with the same exact information, here's the prior screen again, $5,000 deduction ended up giving you $9,000 of taxes. So it's always the case that tax credits are preferred by taxpayers. Tax credits have a more powerful impact on your taxes paid. And the reason is the tax credit reduces your taxes by the full amount of the credit, right? But a tax deduction reduces your taxes only by the amount of your tax bracket. So in that example, I said you had a $5,000 deduction and your tax bracket was 20%. You only actually lower your taxes by the 20% of the deduction, which is just $1,000. Versus a tax credit, you get the full amount of the credit. So a tax credit is definitely what you would prefer to see. And that's actually one reason for that, is one reason why Congress tends to do a lot more tax deductions, is that tax deductions are less costly from Congress's point of view. Right? From Congress's point of view, they're interested in raising tax revenue. So tax deductions are a way that you can give taxpayers something, but in fact it's not a dollar for dollar reduction. The second big lesson of this chapter is something that you might have already learned in the introductory econ class if you took an introductory econ tax. Very important idea, very confusing to most people, and that's the idea that something called the marginal tax is not the same as the average tax. I'm going to give you an example which will highlight this. But the average is you'd calculate your total taxes paid and divide it by your income, and that's your average tax rate. By contrast, the marginal tax is the tax rate on the last dollar that you earned. So here's an example of the two. Okay, this example I did grab from the textbook. Okay. In this example, it's based on something that might be similar to the tax table you might see from the IRS. And again, if you're using an online tax program, this kind of stuff's all hidden from you. The program knows how to look this up. But let me walk you through this example. Let's suppose you have $90,025 of income, okay, and you're filed jointly. This table gives you an idea of how the progressive income tax works. And this is how it's really set up in the tax tables, is that for different levels of income, your tax rate increases. So in this example, for the first $17,000 you earn, you only pay 10% tax on the first $17,000. So from 0 to $17,000, that's all you pay. Then from $17,001 to $69,000, that next chunk of income, you pay 15% tax rate on the next chunk. And then for amounts above $69,000 up to $139,350, you pay 25%. And that's the highest level I need to go to because $90,000, my taxable income, is in between that span. But you can see there's also a 28% tax rate, a 33% tax rate, and a 35% tax rate. Okay, and so let's now go through the calculation. For the first $17,000, okay, the taxable amount is the column that tells you how much income falls into that first tier. Well, $17,000 of your income falls into that first tier. You pay 10% on that amount, so you have $1,700 of taxes due on that first tier. On the next tier, the amount of money between $17,000 and $69,000, that's a taxable amount of $52,000. You owe 15% of that, and so 15% times 52,000 is $7,800. And then you go into the next tax bracket. The next tax bracket is where you fall. Okay, you have $90,025. You subtract the $69,000, which is the lower part of the tier, and that gives you $21,025 of income that fall into this third tax bracket. You pay 25% on that. 25% of $21,025 is $5,256.25. You add up the amount of the tax due in each of the tax brackets, so each of the 3 tax brackets, and I get that your total taxes you pay is $14,756.25. Okay, now notice, this is how we can compare and contrast the average rate versus the marginal rate. Your average tax rate is your total taxes, the $14,756, divided by your taxable income, $90,000, and that's 16.4%. Okay? But your marginal rate is the tax rate that's in effect for each dollar of income that you're currently earning. So that is, right now you're earning $90,025. What's the tax rate if you were to earn one more dollar at that tax category, that income level? That's at the 25% tax bracket. So if you earned one more dollar, you would pay 25 cents to the government and keep 75 cents to yourself. Okay, and that means your marginal rate is 25%. Okay, so for the way the progressive tax system works is for all taxpayers except those at the lowest level, that is 10%, their marginal rate is greater than their average rate. Okay, so while the tax programs often will talk about average rates when you finish doing your analysis they compute your taxes, the relevant rate when you're thinking about should I earn more money is your marginal rate, because that's the amount you're going to pay on your next dollar of income. Now the final slide I want to conclude this chapter is I earlier had spoken about tax credits being far more desirable than tax deductions, and I wanted to give you some examples. You might say, oh, what are these tax credits? Again, you're going to have to drill down in the textbook, which has a little bit on these, but certainly there's a lot more reading available if you had any interest. Here I've listed, I think it looks like 6 primary tax credits right now. In particular, it might be of interest to students is something called education credits to offset college education expenses. You could potentially qualify for education credits. Again, there's rules for whom actually gets the tax credit for that. Not all students can qualify for that tax credit, but it might be something that you do a little work on. Okay, so that's my highlights of Chapter 3. Good luck, everybody.